Do you know what the percent was with the all-in-one?
The all-in-one first lien was 8.75.
Okay, it's a little higher than what they are right now, but that's
But it's variable though, right? So it can come down,
yes,
right?
exactly. Okay, and you have with your home at 444,000.
Yeah.
And then the rest of your debt totals about 60,000. So you would have 504 in total debt.
And that's assuming I eliminated my life insurance loan that I have there, or
Okay.
else not including that. Is that what
Right.
that's included in there, right?
Yes.
Okay.
Yeah, I'm just putting every worst case scenario.
Mhm.
So yeah, you have over 4,400 in food and dining a month. Okay.
Maybe not 44. I mean, the groceries are insane, and whether it's like stuff for the kids is where it's at. I have 4 kids.
Okay. All right. Let's see here. If we took your income and then right now your total expenses stand at 12,689. This is total expenses. Say 12,700. So that leaves it about 3,300 in cash flow per month. Okay, so just going to throw this out there, what this looks like to me. You have $1 million value on the home, approximately, and you're in what state?
Northern Virginia.
90% loan to value, probably at 900,000. Is that what they quoted you?
I didn't go as high as I could. On the agent on the phone said they encouraged to stay under the 70% to get the better rate or whatever. So I was like, well, what's my total? I was gonna do the 500, but then I was like, let's just do the 470. So my limit currently pre-approval is 470, but it could potentially change.
Okay, so the lenders that I work with, they do a 90% loan to value, and then that gives you, in your case, about 900,000 that you can leave sitting there or you can use. So the reason I like to have that available on my property is that anything I come across, so with the market, I would look for it to start going down a little bit myself. And when that happens, I plan on picking up another property. Well, I can pay the purchase price of the new property with most of my HELOC. Okay, meaning that I no longer have 2 mortgage payments. I only have my line of credit that my income is going into and satisfying that payment. So now I have 2 properties on the same line and no payments that I have to come up with. So that's why I like having all of the equity available for things that investments that you want to take advantage of. Then the cash is available. If you don't want to, then it can just sit there. Okay. That being said, your total payoff is 504. And when, let's say you paid off the 504, that's going to give you 2,900 in additional cash flow because you paid off all of your debt. Okay. So 33, 29, you're at 6,200 cash flow. Now, what does that look like on the total debt for interest? So 504 times 8.75. So your first month is going to be your highest, and your first month interest would be 36.75, with an average throughout the pay off of the loan or through the term would be 18.38, let's say. So what does that mean for payoff with this? That means that you're going to pay off the 504 in about 115 months. So about 9.5 years. Now, did that make sense? And what questions do you have about that?
The number 2 right behind is the 3675, and then there was the other number 1838.
Yes, this is the average interest that you would pay throughout the term of paying off this 504, because this would be your very high. But when your income goes in and you make 16,000, this is coming down in your first month. So your interest the second month is going to be lower than this. So it's constantly dropping every month. And when I say your average, that means if we take the average from beginning to zero balance, you'd average about 18.38 per month in interest.
Okay. Gotcha.
Because the point of using the line is they give you a checking account beside of this, at least the lenders I deal with, they give you a checking account here. So all you're doing is using this line as your checking account. So all income goes in, all of your expenses come out. They have checks and debit cards. So you're not even thinking about your line of credit. You're just using it if you need to, write yourself a check or whatever. The point being is that every dime you hit into this line is reducing this balance, which is making this go down really fast. So you're working off your debt about $4,500 a month approximately.
Say last part again, the $4,500, said again?
You're working off your debt approximately at $4,500 per month. This balance should be coming down.
You're saying that's the monthly principal allocation, contribution.
And then any saving that you can due, you know, any additional funds you get. Are you paid weekly, bi-weekly, or monthly?
Monthly at the very last.
Okay, so every time you get
But
paid.
to your point, I was thinking I can shift basically all of my expenses, everything, not into the HELOC, but onto my like Amex Gold.
Mhm.
And then I can then defer like the daily balance lower. And that way
Right.
it's just one transaction at the end of the month, like right before I get paid. And then they'll go up, they'll get down, go down because it's paid off by the credit line, right?
Right.
Okay.
So you work for Amazon, or how do you have the store, or what do you got?
I work for Amazon Web Services, yeah.
Oh, web services. Okay, cool. Well, I think that you've got a lot of resources I mean, you've got plenty of savings, it looks like, and your IRAs and everything else. I think that this would go much faster than you think it would in the line.
So I think I just when I sent you my I think I said two things, Velocity Banking Calculator thing.
Hmm.
And in the first tab, I was thinking that the total, where am I going wrong with my calculation is probably the daily balance or something, because I was estimating on, I think it was like row 20 for this month, that the HELOC interest rate was 3,294. And that's the starting balance of 463 minus the income plus I called it like 13K just to be easy in expenses. So the average daily balance I was expecting was 451. Am I off base? Because am I seeing that the next month is still 3,200 something dollars in interest, which is like far more in interest what I'm paying right now. I was trying to understand where I went wrong or misunderstanding something.
Okay, let me look here.
Because my current monthly interest on my house is $1,248 or give or take. So I'm trying to figure out if I go and do this route,
How long have
then
you been in the mortgage?
total 6 years, but this was refinanced, so start the clock over. So this is 4 years into this mortgage,
And then what's your interest rate on it?
3.375. And then I have a follow-up question.
Okay, go ahead.
So would an opposite strategy be don't do the first lien, but then do a second lien to then pay off my car right now, like as soon as possible, and then free up that cash flow? Or is kind of like one and the same
Well,
with the snowball method, basically, instead of like lumping everything into one?
right. So let me look at your.
Because my car's 8% interest, and I understand your other videos, well done, said like even at 15-20% interest, you can still save because you're getting out of the amortization schedule.
Right.
But using this way, if my monthly interest is 3 times my current interest on just my house, and then my auto interest is 135 or 145, whatever, then it just seems that even if I sum the two of those right now at current, it's less than $2,000. And if I pay off the car faster, I'm just trying to think of this through. Maybe I'm missing something I know.
No, I want to make sure I'm not missing something. So you're saying that you have 26 years left to pay off on the home, right?
That's right.
And so doing Velocity with a first lien brings you down to less than 10 years. And that's paying off your cars and everything with that and your life insurance loan. So you were right about the first month interest. Of course, this is, if you're just doing the 464, of course, this is going to be less time that you're going to spend, because what I did was, like I showed you, is you're paying $2,900 right now in monthly payments. According to your worksheet, you have $3,300 in cash flow already, which gives you a total of $6,200 once you pay off the total debt. Okay.
Once I pay off the total debt.
Once you pay it off, your cash flows up because all of these payments become cash flow now. So I just added it into what you already have. Does that make sense?
I think so. I understand 3,300 cash flow, and then the 29 cash flow is, but I won't be paying it off until, like you said, 9 years though.
Okay, so
I understand paying off more every month, which then reduces the interest of the total balance every month.
Right. But that's cash flow because you're making payments. You're making a $2,160 payment right now on your home. You're making a $376 payment right now on the Explorer. You're making $150 on the life insurance loan, and then the Invisalign is $242. So you have $2,929 in payments you're making right now. When you pay it off in this, all your payments went away. Now you're just putting your $16,000 that you make every month income into this line. So
Oh.
488, then your expenses that you would charge on a credit card or whatever, just your living expenses, food, gas, car insurance, all that would come right back out of here. For real, your interest is going to average, if you paid off everything, you did the 504. So let's say your average daily balance would be 496. So this is the average that they would figure, average daily, then times the 8.75% divided by 12. So let's say that's $3,616 in interest for your first month. Then your average throughout the payoff of this entire term balance would be 1,808 for your average interest monthly. Meaning that if you have 6,200 now in cash flow, you're just paying the interest on this account, which we are figuring in here, 6,200 and say 1,900 in interest for your average. That would give you 4,300 that's actually working down this balance every month to pay off. So you just take the 504 divided by 4,300, and that's 117 months, which is 9.75 years. So less than 10 years. It's just math.
I love when you say that.
I mean, it's just math, and it's the amortization schedules is what gets us caught up, because when we are set up to where we're paying the mortgage interest first, and then we're applying balances to our actual principal, the actual home we bought, that takes us out to 30 years. But when you are just paying the interest on the average daily balance, and you're hitting this every single month with additional income, you're dropping that average daily balance, and any bonuses or tax refunds or anything you get all comes in here. You're working this balance off that's making this available again. So you had a $900,000 limit, and every day this 504 is coming down. Every month it's coming down. So it's going to pay off within 10 years just using it that way.